Thinking about strategically opening many credit cards to try and boost your score? Turns out that's one of the worst things you can do. This is because discoverability of good credit mix secrets is something that lenders don't want you to know about. We'll expose those secrets and a bunch more that can impact you. So what exactly is a credit score? Think of it as a financial report card. It's a 3-digit number that tells lenders how likely you are to repay borrowed money. A good credit score can open doors to many things, like getting approved for an apartment, securing a loan for a new car, or even starting your own business. Aisha, trying to move out, or Maria, wanting a business loan, both need good credit. Your credit score isn't pulled out of thin air. Several things affect it. The most important is your payment history. Do you pay your bills on time, every time? Late payments can really hurt your score. Another big factor is credit utilization. This is how much of your available credit you're using. If you have a credit card with a $1,000 limit and you've charged $800, your credit utilization is 80%. Experts recommend keeping it below 30%. High balances can signal to lenders that you're struggling to manage your debt. The length of your credit history also matters. The longer you've been using credit responsibly, the better. Opening too many new credit accounts at once can actually lower your score because it shortens your average credit age and can signal risk to lenders. Credit mix is another factor. Lenders like to see that you can handle different types of credit, like credit cards, auto loans, and mortgages. But don't go out and get a loan just to improve your credit mix. That's not a smart move. How do you improve your credit score? The most important thing is to pay your bills on time, every time. Set up automatic payments if you have to. Keep your credit utilization low by paying down your balances. Check your credit report regularly for errors. You can get a free credit report from Equifax, Experian, and TransUnion at annualcreditreport.com. If you find any inaccurate information, dispute it with the credit bureau. Be careful about applying for too much new credit. Each application can result in a hard inquiry on your credit report, which can lower your score slightly. Avoid those, especially if you have poor or fair credit. There are many myths about credit scores. One is that closing credit cards will improve your score. This isn't always true. Closing older accounts can actually hurt your score because it reduces your overall available credit and shortens your credit history. Remember, building good credit takes time and responsible credit use. There are also things like secured credit cards for credit building. Be very wary of credit repair companies that promise to fix your credit quickly. Most of what they do, you can do yourself for free. And if something sounds too good to be true, it probably is. While we've covered a lot about understanding and improving your credit score, there are still some unanswered questions. For example, how do different debt consolidation strategies really impact your score in the long run? And what are the best ways to navigate credit challenges after a major life event like a divorce, like Chris is experiencing? These are topics for another video. If you found this helpful, please like, share, and subscribe for more financial tips and tricks.